So welcome everyone to this panel about financial innovation, building societies and financial wellness and resilience. My name is Marloes Nicholls and I'm Head of Programs at the Finance Innovation Lab. I'm going to be chairing this panel and I'm really excited and curious about the conversation we're going to have. I think it's important for three reasons. Firstly, it's an absolutely crucial topic. At the lab, we believe that finance and innovation should never be ends in themselves, but should always be designed to deliver better outcomes for individuals, society, and the environment. Secondly, it feels like a very timely discussion. So social distancing has put lots of pressures and brought opportunities to digitize finance. But on the other hand, we have a public health and economic crisis, which is creating horrendous strains on people's finances. And finally, we've got four fantastic panelists here with us today who bring perspectives from inside and outside of building societies and whose expertise spans everything from financial inclusion to public policy to product design. So thank you all for joining us. We have Gareth McNab, who's Social Innovation Lead at Nationwide. We've got Michael Royce, who's Senior Policy and Propositions Manager at the Money and Pensions Service. We have Mick McAteer, Founder and Co-Director of the Financial Inclusion Centre, and Patrick Muir, Vice Chairman of the Family Building Society. So to kick us off, I'd like to just ask a couple of contextual questions. And my first question is, what does financial wellness and resilience mean? And I thought we could kick off with you, Michael, because I know you've done a lot of work with MAP developing the UK's financial wellbeing strategy.
That's right, yes. So the Money and Pensions Service, which is at arm's length from the Department for Work and Pensions, we were set up by an Act of Parliament, bringing together the previous bodies of the Money Advice Service, PensionWise, and the Pensions Advisory Service. One of our statutory duties is to develop a UK strategy for financial well-being. We realise we can't do that on our own, and many organisations across sectors in government, financial services, and the community and voluntary sector, and the education sector have an important role to play here. What we've done, based on the evidence we've accumulated, is identify 5 broad pillars of financial wellness, financial well-being, and these are linked to people's ability to build savings, their ability to use credit in affordable and sustainable ways, their ability to access debt advice when needed, and their ability to understand planning for retirement throughout their working lives, and then managing that money in retirement. So those 4 main pillars. Alongside that, there's one as well on the building blocks of children's financial education. Cutting across those 2 areas, we've identified where in society there is another lens that we need to apply onto this. One of those is around gender and financial well-being, and another is on mental health and financial well-being. Those are 2 important cross-sectoral themes that we need to thread into those main pillars of financial well-being that we've identified. A third one that's becoming more and more apparent is how we support those from BAME communities. But clearly all of these areas interact, and we want to ensure in the recommendations that we pull together for the UK strategy that will take us to 2030, that we consider all of these lenses in the proposals that we put towards government, towards the financial services industry, and towards other sectors, including employers, to take us through to 2030. Clearly, fintech has an important role to play, but what we want to emphasize is that it's just one key element of an overall package of support in how we reach and support people to build their financial well-being across all those areas that I've outlined.
Brilliant, thank you. And Mick, I wonder if you've got anything to add to help us understand what financial wellness and resilience mean, and we'll come on to fintech later in the conversation, but just starting with those concepts, how would you understand them?
Yeah, thank you, Marloes. I mean, at the Inclusion Centre, we talk about financial resilience and financial wellness in the following terms. Really, I think it's really about being able to withstand economic and financial shocks. For example, being able to meet an unexpected bill, for example, is a good illustration of that. But you mentioned COVID already, and I think what COVID has exposed is that an awful lot of people, millions of households, really came into the COVID crisis with very, very low levels of financial resilience, which meant that the economic impacts were actually exacerbated what was already a very, very difficult financial position for those households. But I think it's almost there's a wider concept really of financial resilience, and I think that's about financial wellness. It's about also making sure that your financial position doesn't create mental health issues, or it doesn't cause anxiety, it doesn't cause problems in the workplace or with family relationships. We know from the evidence that financial problems can actually create wider set of sort of collateral damage as well. So it's part of a bigger concept really of financial resilience and financial well-being. And I think there's also, something that's often overlooked as well is that when we look at financial well-being, we also talk about people not over-consuming the wrong type of products, and under-consuming the right type of products. So for example, before the clamp down on payday lending, too many people were over-consuming credit, really, and before the introduction of the tougher consumer credit lending standards, and they were under-consuming savings. They weren't saving enough. So again, we had the balance right there. And people were as I say, they were over-consuming the bad stuff and under-consuming the good stuff. And then the last thing I'll just mention, really, to add to what Michael was saying, is that I think it's really important in all these conversations when we talk about individual financial well-being and individual resilience, we can't ignore the environment that people operate within. And so we often talk about people having to deal with sort of toxic financial services. You can't have individual financial well-being if those individuals are forced to deal with what can sometimes be a toxic financial sector. So it isn't just about the individual, it's about the environment, the healthy environment that they have to operate within as well.
Brilliant. Thank you both for bringing those concepts to life for us. And I wonder if, just thinking about the context again, Gareth and Patrick, could you say a bit about the role that building societies can play to help improve people's financial well-being? And you might draw on some historical examples as you do that. And I wonder if, Gareth, would you like to kick us off?
Thanks, Marloes. So I think building societies historically have played a key role in supporting financial wellness and resilience. I think that the movement started in order to improve the financial resilience of a whole class of people. Nationwide's founding documents talk about enabling the industrious classes to build and own a home. And that's really at the core of what it means to be mutual. It's the bringing together of people from different parts of society to be able to do more together than they could on their own. And I think the other lens that the building society movement shows quite powerfully on financial resilience and wellness is when we speak of members, that's not a euphemism for a customer. Our very ownership model requires the end user to be right at the heart of every decision made at every layer of our organizations. And I think that model really helps building societies provide sustainable financial services to communities, and for the larger ones, to the whole country. I think that means that keeping to your core is quite helpful. So not playing so often with some of those riskier fringe margin financial products, having a strong heritage in residential mortgages and in enabling people to start to save safe places. I think that's key to financial resilience. Building societies themselves being financially resilient means that people don't need to worry about where their savings are going. And then I think there are some reflections on what being a modern mutual might mean. What would a 21st century building society do today? And I think it would do things like work out what can you do with that business model and that long heritage in member-focused innovation to be able to do what needs to be done today, which is bringing the best talents from fintech sector and others to build good quality, the right kind of products, as Mick talked about, in order to deliver against those financial well-being pillars that Michael talked about. Open Banking for Good was a program I led that I might refer to later, but there are other movements from the Cambridge Building Society seeking to be able to promote the rental sector and build properties. Nationwide doing the same in Swindon. Lots of other innovation that is relentlessly focused on members first in everything we do.
Sounds really exciting, and it'd be definitely good to talk more about that in a minute. And Patrick, I wonder if there's anything you'd add to that about the role building societies have traditionally played in supporting financial well-being.
Yeah, I think it goes back, as Gareth was saying, is back to the heritage of the building society. Basically, you know, when building societies were formed in the 19th century, the 18th century, there was barely a town in the UK that didn't have a friendly society or a building society kind of named after it. So their very presence in the high street, and going back to their very formation, where, you know, in order for groups of people to get together to put money in to start to build each other homes, you know, that they were originally positioned in taverns and coffee houses and places like that, and then moved on to the high street. So they've always been kind of at the core of the consumer and where the consumer is and what the consumer sort of is thinking about at the time. And I think sort of moving forward from them, in order for building societies to continue to be relevant in the current sort of marketplace, then that original kind of mantra of thrift and prudence is ever more important. Now, with the consumer, it's not always a very popular or kind of a sexy subject matter. We don't want to sit down and have a lecture about prudence every day of our life. But in terms of being relevant in these difficult times, you know, that sort of proximity to the customer and that continued message and offering of ways to do the right thing. And then finally, you know, with the exception of probably the 2 or 3 very largest societies, the actual size and scale of the building society enables it to be much more personal and sort of high touch with the consumer, where, you know, the giant PLC factory ships financial service providers rely on automation, robotics and everything else to try and reduce customer touch points as much as possible to increase efficiencies. For a lot of our members and a lot of members in general of societies, you know, being able to deal with something that's a little bit square shaped in a round hole from time to time, and have a conversation and have a much closer relationship with different sorts of customers, with vulnerable customers, for example, you know, is exactly where building societies can show up in a world of sort of financial resilience and to use a modern phrase, financial wellness.
Great, and I think that leads on to my next question, really, which is, you know, thinking about the present moment and the innovation and digital transformation that's already underway in building societies. Do you see a tension between that on the one hand and supporting financial well-being and wellness on the other? And I wonder if, Mick, you could speak to this issue.
Yeah, thanks, Marloes. I think it's a really, really interesting question, you know, and I know that a lot of people will recognize that that we're a bit skeptical about the digital transformation program. You know, I mean, of course, some people will do very well out of it. You know, it will benefit a lot of consumers. You know, but at the same time, I think we have to be honest about this and recognize that, you know, that the history of financial services tells you that whenever you have customer segmentation and when you have more precise data profiling, that tends to lead to more exclusion and sometimes outright discrimination as well. And I'm sure we'll come on to it, but it also leads to other things like, you know, cross-selling and aggressive selling of products and using behavioral insights to exploit consumers rather than benefit consumers. But I think the main worry, as I mentioned, there really is that, you know, the more fintech we have, the more big data we have, and the more digitalization we have, then that facilitates even greater segmentation at an incredibly granular level, you know, of the consumer population on different households at different level, at different local authority levels, postcodes and so on, you know. And we're now moving to a world where people used to be sort of almost profiled on their financial risk, and they're being profiled now on their character, even by proxy. So I think I would conclude actually that there's just as much risk of actually greater exclusion and greater discrimination as a result of digitalization as there is for potential benefit. It all depends, of course, on how this is handled. Any technology can be a force for good if it's used properly, and I think really that's where the industry and the regulators and civil society groups really have to get their act together on this one and make sure that digitalization is actually used as a force for good rather than a force for bad. I mean, I'm a huge fan of building societies. I really cut my teeth when I was at Which magazine, running a campaign trying to stop building societies converting to PLCs. It was one of the first big projects I did. We actually analysed the mutual dividend. And we tried to persuade lots of consumers that they should vote to keep building societies mutual, because we said it was in their long-term interest to vote against conversions to PLCs. We didn't always win, but I think we did help sort of stop nationwide converting to a PLC. So I'm very, very conscious that mutuality and membership-owned organisations should, in theory, offer a considerable advantage to consumers. But I think it's also equally important to recognise that building societies do not operate in a vacuum. They are competing against PLCs, and history also tells us that a lot of building societies were actually guilty of the very same practices that PLCs were during the fiercely competitive days of low price mortgages, cut price mortgages, PPI mis-selling and stuff like that. So it's really important to recognise that as I say, they don't operate in a vacuum. They will have to hold their nerve. They will have to demonstrate that they are different to PLCs, and they will have to resist the temptation to use fintech and big data to maximise profits or extract value or indeed discriminate against consumers. There's no guarantee it'll be a force for good.
Thank you, Mick. And it reminds me of something that I'm quite interested in as well, which is how can we create mutually owned other parts of the fintech ecosystem that could potentially collaborate with building societies to try and push out that vacuum. Are there any other views on the panel about this tension that anyone would like to speak to? Is that Gareth? Would you like to?
I do see one, Marloes, which is around digital transformation isn't only around putting digital tools or fintech tools in the hands of members. The digital transformation that many building societies are undertaking at the moment are in order to scale from old legacy infrastructure to be able to ensure that we can continue to build new products and services, mainstream products and services, not fintech only, but the kind of layer to be able to help us move data, hold our ledger systems and so on. I'd still put that as digital transformation that is absolutely vital to the infrastructure of building societies. And one of the tensions that we have there is investing in infrastructure now while others are investing in front-facing or customer-facing whizzy apps and tools, ways of lending money that doesn't necessarily feel like borrowing, ways of collecting debts that doesn't necessarily feel like debt collection. If we pour all of our efforts into updating infrastructure, then we could fall behind on those customer-facing tools. And also as we use digital transformation to be able to grow market share. We do need to remain profitable because we have to be able to pass the interest we charge on our borrowing or on our lending onto our savers. And if we can't attract new savings, we can't lend out. And if we can't lend out, we can't attract new savers. And so our very business model requires us to continue to seek to at least keep pace with the market, if not to grow. Now, the kind of where you put your limited resources, infrastructure maintenance, growth, or service, I think is going to mark you out. And numbers of us in the building society movement, choices we make now on those three piles of digital transformation could directly influence the levels of financial wellness and resilience in society in the coming years. I don't know what the right answer is. I definitely don't want to leave all of the front-facing innovation to the new players. I think the fintech sector needs the building society movement's relentless focus on members first. I think it needs our values and our heritage in order to remain rooted in keeping the customer at the heart of products they build, rather than purely a profit motive. So I think we need to be in that front bit. I think there is a legitimate debate to have about how much you put on each of the three piles.
Great, thank you. So I think we're starting to surface some interesting tensions and choices and risks, and I'd like to come to those a bit more later. But I think maybe just looking at the kind of opportunity a bit more, be really interesting to hear from Patrick. What do you think are some of the best examples at the moment of building societies using innovation to support members' financial well-being?
Well, I think pretty much to a society, every society has been through probably the most aggressive digital transformation program that they've ever embarked upon in the past 6 months, with the advent of lockdown, multi-lockdown, regional lockdown. With branches, we have mortgage pipelines to serve. We have customers wanting to get £100 out of their savings account, withdrawing all their money from the savings account, and lots of boys and girls, men and women, sort of manning phones, computer screens, underwriting systems, all trying to work from home. You know, we've all been coping. Our people have been coping with putting in place very far-reaching innovations in terms of processes in the past few months. When it comes to sort of the other means, I think what a lot of the societies have done, which has already been alluded to, is to look at which markets they're really serving. Whether that's the rental sector, whether that's the mortgage to new build kind of sector. You know, in our case, it's been sort of multi-generational lending into retirement, looking into those areas where there's a significant need. It's not a particularly high risk need. It's not sort of jumping into the subprime world or the near prime world or any of the other phrases people have come up with to justify scaring the life out of shareholders. You know, in terms of, you know, just sort of blowing our own trumpet, is, you know, if we were still trading as we were when we were formed in the 19th century, you know, I'd be here as Patrick Muir, vice chairman of, I think it was the Post Office No. 2 Building Society. So that then became National Counties Building Society, which again just didn't seem particularly relevant to the target audience that they were looking for. So rebranding to the Family Building Society with a completely new look and feel. You know, it's not just making the brochures look prettier. It's basically about cementing the position of the organisation and its products and its services closer and closer to something that people will recognise as being for them. So it's sort of reinventing how we look and feel, and therefore then the products and services that we need to be coming up with, not just for our members and savers, but also for the markets we serve, whether that's sort of raising funds through the wholesale markets, local authority funding, or whether that's the you know, since the changes to mortgage distribution regulation, you know, the vast majority of mortgages are now not done directly, they're done via broker networks, and therefore your relationship with the brokers, the broker networks, and how that shows up, and what kind of underwriting processes you put in place to support their relationship with their customers, you know, all require different levels of either human innovation or technical innovation to make sure it works as well as it can. There's a tendency when we talk about innovation these days, you know, it's about being able to send money to somebody on the other side of the moon, or a digital process that's completely invisible but works brilliantly, and you have now half the world sort of walking on high streets talking to themselves. You know, when Family Building Society was originally the Post Office No. 2 Building Society, if lots of people were seen walking along the road talking to themselves, they'd probably all been burnt at the stake as witches. But a lot of innovation is not massive big tech innovation. It's not scary front office use of data against customers. It's small things that make the process better, or remove some of the annoyances that we all experience every day when we're buying or consuming products and services. I remember when we were at Egg, we had a big program. We had a savings product, we had mortgage products, we had loans products, we had credit products, and we wanted to get everything put on one statement for customers. That was sort of a 9-month project, millions of pounds, and very clever people putting it all together, just so we could serve something to a customer that was an example of, you know, what we call today in regulatory circles, your single customer view. And everyone was rightly proud of this momentous achievement of getting all these systems to talk to themselves and to produce this for a customer. And the feedback from the customers is, well, that's what you should have been doing all along. And quite often, our best efforts at producing good things for customers, of innovating stuff that maybe isn't this sort of invisible voice in your ear, you know, the best you can hope for the customer is that's what you should have done.
Yeah, no, that's a very important point, I think. I do wonder, though, if Gareth, you might have some examples of fintech innovations, just because of the topic of the conference as well. And obviously, as Patrick has described, innovation is never just about tech, and there's never always just going to be a quick fix. But I would be interested to hear about your experience from Open Banking for Good. And also, just to say, Michael, if you've come across any interesting examples of innovations by building societies through your work, it'd be great to hear that afterwards as well. Over to Gareth.
Patrick makes me smile because I think it was Nationwide put the first contactless card transaction in space. And I know, I mean, well done us, but I'm not sure quite why. I mean, it will help the 6 people in the International Space Station, but I didn't work in the innovation team at the time. Innovation, good innovation, member-focused innovation, societally useful innovation needs to have the consumer, the end user, relentlessly at the heart of it. I think some recent examples that I'd bring in here would be how the building society movement, although we weren't unique to this, mortgage lenders across the whole market had to move heaven and earth in order to deploy payment holidays very quickly to a great many people this summer. At the height of it, 1 in 7 residential mortgages in the UK were on a payment holiday. And if we all processed those in the way that we used to process payment holidays, that would have been an awful lot of paper ledgers and an awful lot of recalculating compound interest over long terms, which I'm sure Mick and Patrick could do in their heads. But I didn't get taught that at school. So within the payment holiday process, of course, innovation would say, or fintech would say, get it done fast. And indeed, most of us did. Nationwide had an end-to-end process for a digital end-to-end journey in place within 48 hours of the announcement that we had to provide these payment holidays. And that was an automated end-to-end process within 8 days, which is just incredible timescales in a large financial services organization. Now, we could have stopped there, because if you can do it and you can do it fast, you've done the most important things. But you also want to make sure you do it right. Doing payment holidays quickly, but without being able to present some kind of calculator to indicate the impact of taking these payment holidays, especially given that our regulator and the government didn't require us to take any other information. In fact, they actively required us to just take the customer's attestation that they needed the payment holiday. Nationwide worked hard with a fintech provider to be able to quickly tie in a microservice to be able to provide a calculation of the impact of this upon your mortgage, to try and provide that view to the customer of, are you sure you need this? And if you take this, this is the impact on you. Now, for many people early in the life of their mortgage, the impact on their monthly payment would be negligible, but the impact on the overall amount they pay for their mortgage across their lifetime could be massive. And so, are you sure? Now, I think that's an example of how building society values and fintech pace can do it fast, but also do it right. And I think that's a decent example from recent history. I think still in that COVID space, you have work that I'm undertaking right now at Nationwide, where one of the graduates of our Open Banking for Good program, OpenWorks, are providing an open banking powered affordability assessment for our collections department. Now, why is this important? Well, open banking provides opportunity to increase accuracy on these affordability assessments. If I was to ask my four co-panelists how much you pay on your council tax each month, a couple of you would know, but a couple of you would guess. Now, if you do that across every one of 85 questions on the standard financial statement that's in use in debt advice and in debt collection, you could be out on your, when we stop and calculate your disposable income, you could be out by many tens and perhaps even hundreds of pounds, either in such a way that would underpay your debts and therefore charge you more interest over the life of your accounts, or would have you making unaffordable commitments to repay your debts, putting you in further financial difficulty. So increased accuracy is a consumer-focused benefit. Faster, it's between 20 and 40 minutes to complete such a statement with a debt advice organisation, but being able to populate large parts of it through open banking, it cannot be fully pre-populated. And while there may be attendees at the conference will insist that they can, I will happily take them for a beer and persuade them why they can't. And even if they could, they shouldn't. The accuracy is higher, the pace is higher. If I've managed to get hold of a customer within a payment or two of them getting into difficulty, or ideally before they've got into difficulty, I've got them for a finite moment of time while I have their interest. Now, if what I'm about to ask them to do is hard for them, will take a lot of time or take a lot of information for them to go and get manually, I may not get what I need in order to help them or to help them help themselves. And so making it faster and making it more accurate is good for the consumer. It's also good for us because when you set a repayment plan based on a more accurate assessment of affordability, while the monthly payments might be slightly smaller than would be put together based on a budget that somebody had guessed or put their finger in the air, the plan you set in place is likely to be stickier. That is less likely to need further intervention from us, because the payments themselves are confirmed as affordable in a way that the consumer sees and believes in. And so I think fintech, open banking, other technologies can be deployed for good, but I strongly agree with Mick. Fintech alone cannot be expected to take their technology and these consumer opportunities and stay on the straight and narrow, because there are profit opportunities and there are influence and data opportunities that could become too attractive even for the founders' best interests. And so I think the building society movement and campaigners like Mick and organisations like MAPS need to stay really close to the fintech community, welcoming the best of them and offering our time and expertise to help them keep it relentlessly focused on the consumer good.
Thank you, Gareth. And Michael, were there any examples you've come across in your work that you wanted to share?
Yes, absolutely. I'd like to give a special mention to Yorkshire Building Society. We've been working with them on what's called our sidecar savings field trial. That's a form of payroll deducted savings where the savings product is linked to the workplace pension. And Yorkshire Building Society is one of the partner organisations. We're testing that in the field now with employers such as BT, Timpson, and the staff at the University of Glasgow, and Step Change. They're coming on board too. How it works is the cash savings product is linked to, provided by Yorkshire Building Society, is linked to the workplace pension, whether it be the Nest workplace pension or from another provider. There's a cap on savings through monthly payroll deductions. Once that cap is reached, any excess payments flow into the workplace pension accessible at retirement. But the liquid savings pot always remains liquid, and so the person can access those funds for an emergency, or if they've saved for a specific purpose, they can access those funds at that time. And then the payments start again, rolling into the cash savings account until the cap is reached. So that cycle continues. So we're very pleased with the enthusiasm that Yorkshire Building Society has put behind working with us and the other key partners in testing this scheme. I'd also like to make a very quick reference as well to Leeds Credit Union, not a building society, but they are members of the Building Societies Association, and we've been working with Mick and his colleagues to test. It's the other side of innovation. It's all very well having the lovely technological solution, but through Leeds Credit Union and its payroll savings scheme, we've been testing how we can build engagement to want to open a payroll deducted savings account through staff champions, for example. So, and then obviously try to get more of their co-workers to open a payroll deducted savings account through the Leeds Credit Union scheme. I think it's just a marriage of the two, both the people-led innovation and the technology-led innovation that hopefully maximizes the outcomes for the intended beneficiary.
Great, two additional really great examples. And Mick, I'd love to turn to you now and ask, I mean, now you've heard some of those examples of opportunities for innovation. Do you think, is that ambitious enough? Is it good enough, given the kind of financial well-being challenges we face in the UK? But also, are there risks to some of the examples you've just heard that haven't been highlighted?
Yeah, that's really interesting question, because I mean, the thing that stands out about those particular interventions that Michael and Gareth have described is that they're actually using technology to give a boost to what are very, very simple processes. These are not sort of shiny new sort of fintech stuff. This is doing the basic stuff better. And that's when technology can really make a difference to financial inclusion. If you think back about the innovations that have probably made the biggest impact have been the ATM machine or the direct debit or the debit card or whatever, I mean, they're very simple technologies, for people to use, even if the technology behind might be sort of quite complicated, but they're fairly simple processes. So technology and digitalization will make a difference if it manages to actually reduce what we call the kind of the unit costs or the distribution costs of reaching underserved households. We've tried demand side interventions, we've tried financial capability and stuff like that. That has had a very little impact. It's when you actually improve the distribution channels, and whenever you reduce the unit costs, that is the way you actually make a contribution to promoting financial inclusion. So we would obviously very much support those initiatives. The sidecar initiative is a great one because it is building on the success of automatic enrollment. So anything that gives a boost to established processes, I think, is definitely the way forward on that one. But in terms of risks, then, it isn't that hard to imagine several risks involved with the rollout of fintech and digitalization. And we published a paper, I think probably 2 years ago now, called Fintech Beware of Geeks Bearing Gifts, and it just really, we just wanted to highlight really a number of risks. One of the main risks, obviously, I talked about the higher risk of financial exclusion and outright discrimination, because it allows for people to be, profiled in a more granular way. And as I say, the history of financial services is with segmentation comes exclusion. It comes increased use of risk-based pricing. If you have risk-based pricing and segmentation, it allows financial institutions to identify with more precision those households which are profitable and lower risk, and those households which are less profitable and higher risk. That almost inexorably leads to greater financial exclusion. But it's also there are other risks as well. At the start of the digitalization kind of process, I think there was a kind of this view that sort of believed that fintech and the internet would actually level a playing field between individuals and financial services providers. They thought the internet was going to be a great enabler, that would give consumers agency to help them take on very powerful financial providers. I mean, that's just not the case, actually. I think one of the insights that we always try to get across is that whenever people talk about competition in markets, they always assume that that's going to lead to better outcomes for consumers. It leads to better outcomes for a small number of consumers, because what they don't talk about really is that, one of the, competition in financial services is often characterized by either consumers competing against each other. Don't forget that. It's a really important facet of competition. Someone who's better off, more empowered, who's got higher income is competing against someone who's less empowered, who's got a lower income. And in a market where it's usually a sort of a zero-sum game. If one group of consumers do well, that has to be at the expense of another. So again, fintech and digital big data and stuff really sort of, exacerbates that sort of competition between consumers. And the other element of competition is, of course, the big one is that providers and intermediaries are actually competing against consumers to see who can extract the most value from a transaction. That's the essence of competition. And as I say, there was a view that actually fintech and big data would actually allow consumers to gain power over providers. If anything, it has allowed providers and intermediaries to actually get more power over consumers. And that's why you see, the really clever fintech people, will always be ahead of the FCA and others when it comes to the use of behavioral finance to try and manipulate behaviors and to try and get consumers to buy products they don't need or actually want. So again, I don't see this as a leveling playing field. I actually think this is going to make it harder for consumers to get, less empowered consumers to get a good deal from financial services. We always, some people believe that fintech and digitalization would actually lead to disintermediation in financial services. There would be more direct relationships between the individual and the end provider. But in fact, what we've seen with fintech is actually there are even more intermediaries coming into the supply chains, and those intermediaries have to get paid. They have to extract value in some way. So again, I don't buy this argument that fintech and digitalization will actually necessarily lead to more efficient financial services from the end user. And it actually makes it even harder because there are more intermediaries in the supply chain for consumers to exercise their rights and get redress whenever things go wrong, because it is more difficult now to establish who is culpable for actually mis-selling or for selling a poor product, because there are simply more intermediaries in the supply chain. So yeah, fintech, stick to the simple things, do the simple things better. That's where you'll make progress, but there are plenty of risks on the downside as well.
Brilliant, thank you. You've raised so many interesting issues there, from competition to big tech and parallels with the internet. And I think what's most important is power, and how innovation can lead to a shift to more power to people, communities and society. And unfortunately, we're going to have to wrap up because time has just flown by. But I thought, just to end the conversation, if you think to 10 years in the future, a world where building societies are supporting their members to be more financially well and maybe to have more power, what's one thing you'd like to see building societies do now to get us there? And you're going to have to be quite quick, just so if we do a quick round and then I'll wrap up, and that'd be great. So if we start maybe with Patrick, one thing.
Well, my fellow board members will sigh when they hear me say it, because they've heard me say it quite a few times. But what I'd love to see is what I think, and apologies if I've got this wrong, Gareth mentioned earlier, which is kind of a reinvention of mutuality for the modern world, in a world where customers, to be honest, don't really value the control that they have in being a member of a mutual organisation like a building society, because the benefits of that kind of ownership structure maybe aren't apparent to them. Is finding ways of completely reinventing that model so there was an advantage for the customer and the society, and a sort of beautiful coming together of the two that is relevant and can take it to, in sort of a competitive terms, take it to the big listed banks and the little mini fintechs.
Great. And Michael, what about you?
I think do our best, do the best to avoid the failure of some aspects of open banking. In fact, make it more integral that it's human-centered design for how we develop innovation to support consumers. Going back to Mick's point, power to the people, by human-centered design, understanding their needs. If their needs are simple, designing simple processes to enable those processes to happen. If they're more complicated, understanding the complications from a human-centered perspective rather than a technology-led perspective, and then let the technology flow from that. I think if building societies can crack that nut, they will have progressed a long way.
Thank you. And Gareth?
Communities and members are financially healthy and resilient. I think one of the ways we'll have got there will be what Patrick described in terms of making mutuality meaningful. We can't say being a member of a building society will get you a higher interest rate on your savings or a lower interest rate on your loan, because in a zero or even negative inflation base rate environment, that's a promise you cannot sustainably keep. And it's kind of the lie that's been sold for 20 odd years, is that you can compete on rate. Ultimately, you save because it's good for you. You borrow in sustainable ways because it helps you gear your family towards your financial goals. If we can change the way that we describe our savings and borrowing products as a way of helping you meet your goals and become financially healthy and increase your resilience, rather than, well, my rate's 0.1 better than your rate, if we can change the terms of that conversation, we'll have done really well. And one of the ways I think we'll know when we've done it is when a mutual ownership structure is taken on board by other organisations or sectors as the most sustainable way to deliver those outcomes fairly. So I share your dream, Marloes, of a mutual ownership or cooperative ownership structure in fintech and other sectors.
And then finally, Mick.
Yeah, could I be cheeky and ask and just make a plea to building societies and then make one recommendation? My plea is to, whatever happens, please don't lose sight of the mutual principle, because if there's one thing that defines digitalization and fintech and big data, is that it is leading to an increased individualization of society, and that runs contrary to the mutuality principle. I think you're going to face quite a struggle actually managing those two competing tensions, with the emergence of even more fragmented individualistic technologies. But then my hope for the next 10 years is that let's be honest, the biggest cause of financial exclusion is poverty. It's by time we actually just faced up to that, and stop beating around the bush. Therefore, in 10 years' time, what I'd like to see is an improved social security system that actually protects people against financial shocks. But on top of that, building societies and mutuals have got a tremendous role to play in helping people build financial resilience on top of that foundation provided by a decent social security system. And the way to do that is just as Michael and Gareth described, really, it's about doing the simple things really well, helping people save money, helping them get insurance, and helping them get access to affordable credit as and when they need it. That's my simple sort of recommendation.
Brilliant. Well, I think we've got the components there of an incredibly effective strategy, and I hope that we continue talking about these issues together, but also with the attendees of the conference. And thanks so much for your time. I've just got a message to share with the viewers, so please stay on the main stage where there'll be a panel on accelerating innovation through partnerships. So that sounds fun. But yes, thank you so much again, and I hope you have a good evening.
Thank you.
Thanks, everyone.
Thanks, folks.
Cut.